Okay. So again, I know this is like a bit of a drier topic, but I think as we unpack this and understand it, and especially when we get to like the how you use them a little bit strategically, you're going to be like, I need to pay more attention to this.
I'll find a way.
So let's pretend you've got two. We've now got two properties. We've upgraded Grant. We've got two properties. They're the same on the same street, and they're the same house. So maybe it was like we bought a townhouse, and we've had the opportunity to buy the one next to it. Why not?
Ooh.
So we had a $100,000 property on 1%, and now we've got a second one, a $100,000 property on 1%. It's full 100% loans on these as well, right? There's no deposits. We're
going
feeling risky.
Let's do it.
Okay, so one's on P&I though, so principal and interest loan, and another one is on interest only. And they've both got $50,000 in each offset account. Which, by the way, if I was going to put 50 grand in the offset account, I might as well have just left a deposit so I didn't have to pay the LMI. Like, anyway, we won't go there.
No,
this is not.
We're going full delinquents. This is great. I like it.
Okay, so you would think, Charlie, the same. Like the $50,000 is going to offset the same amount of debt in both of them. And I would say,
it's an offset, Charlie.
Yes, except with the one that is interest only. So we'll start there. There's $50,000 in the offset account. When it comes time to make your payment, instead of the bank taking $1,000, because that was the payment, they're only going to take $500 because that is the new interest amount.
And I keep the rest.
Yeah, so you get to keep the $500 in the offset account in your pocket. Perfect. Now, for the one that's on P&I though, right, so this is principal and interest, they still take the full $1,000. And you say, well, what do they do with the $1,000? They actually pay more of your principal down. So this is and this is where we start to get strategic, right? Because if you're trying to manage cash flow in this example, and your objective is to look at that in a different way, you're not actually getting any more cash flow if it's a P&I loan with an offset account. You didn't keep more cash in your pocket because the same amount of capital was still made illiquid. It's just more was paid down on the debt itself.
Is that just like the option? Is that like an option on the form, or is that just how the difference between P&I and interest only works from an offset account perspective?
That's how they work.
Amazing. Isn't that I've only ever hammered interest only loans. Like I'm just like, cool, just don't need to do principal and interest. It's not what I'm going for personally, and not financial advice or anyone else. Like, I'm an idiot, and it's probably the dumbest thing I've ever done, or the smartest thing, one of the two. And yeah, so I've never actually gone down the P&I road.
Well, funnily enough, when we were going on our acquisition run, one of the things we did to access finance is we did every loan on P&I. Right, so every acquisition we actually made was on principal and interest. Right, we did the full thing. And the reason for that is if you do principal and interest loans, it actually increases your borrowing power slightly. So to be able to maximize what we were doing, that's the way we elected to take it. So it worked really well. Unfortunately, though, what ended up happening is our cash flow changed dramatically. So you want to imagine that we're putting money in these offset accounts. And it really hit me when I started to speak to other investors. So this is one of those things where you don't know what you don't know. Is all my loans are on P&I. I'm putting money into these offset accounts, but my actual like cash flow isn't improving. Yeah, and I'm like, oh, what's going on here? And then it occurred to me that most investors were using interest-only loans, and by putting money in an offset account with an interest-only loan, is they were better able to hold on to liquidity and improve cash flow overall.
Isn't that interesting though, right? Because there are so many times when you listen to people like us on a podcast, and we're like, in another episode, we'll just say, oh, we're just going to put $50,000 in an offset account to sort of offset the interest. And everyone's like, great, I can apply that to me completely. When it's like, well, is your mortgage principal and interest, or is it just interest only? Because it will factor differently. But a lot of people don't go below the surface. And I think this is where a lot of people get caught out, because it's like that second and third layer of information, which is like, oh, shit, I didn't realize they operate differently. Far out.
Yeah, so at this point, I would hope for yourself, you start to go, well, hang on, that would mean that an offset account attached to an interest-only loan has a different value to how I utilize cash in my portfolio versus one that's on P&I.
Completely. And
if the goal of my portfolio is just to maximize cash flow, then interest-only offset accounts start to weight where I might, and I say might, not financial advice, we'll probably have to say that 100 times on the episode, where I might put some of my capital or where I might store more reserves because I don't want to look up that liquidity. Can we get more complex now?
Hey, please tell me you're going to throw in some structures.
Well, I mean, it's in the episode notes. You know it's coming. So
wait. No one knows.
Don't act so surprisrised.
Give me. Oh my gosh, we're going to be talking about structures, yeah?
Is he going to throw in the set of steak knives? Don't tell me he's going to throw in the set of steak knives.
Don't. I'm like looking at the next bullet point. No way. Is it structures?
So this is where it gets even further. So for myself, so you've got this one layer of like, okay, my loan type dictates how the offset account may work or have value to me. But now we're going to go into the structure component. And again, I have to say not financial advice because I can't advise people on structures. That's actually a question probably for accountants or tax lawyers or something like that.
I would be disappointed if you didn't say that.
You're welcome.
Yeah, thank you.
If let's say you have a mortgage in a family trust versus you have one that's in your personal name in this example. So now we're going to change it. We'll keep the same two properties. Why not? But we'll change the structures a little bit. So one of the things that's really interesting in Australia is that you cannot negatively gear within a trust. So if you've got a property that runs at a loss in your personal name, you can actually offset that loss against your income. And that's known as negative gearing, and there are some tax benefits to that. As a sidebar, there's many people in Australia out there that use negative gearing as their strategy. So they're intending to lose money on the properties they have, and then overall, they claim that tax differential. Where if you buy property in a trust, if you run it at a loss, the trust actually has to retain that loss. So it has to deal with its own loss. Now, what I've just said actually goes deeper. I'm sure there's someone out there saying, oh, Charlie, that's not how it works. There is levels of complexity of this. I just want to keep it simple for understanding. What's really interesting, though, is that if you have an offset account in a trust, right, and you are to store capital in there, you can actually strategically put money into that account, which would then improve the profitability of the trust, which would mean you can actually control if you wanted it to be, in this case, positively geared or negatively geared. So in the idea that you wanted to make sure you didn't incur losses in your trust, you don't want to negatively gear in it because you would prefer to maybe negatively gear in your personal name, you could actually move money from a property that's in your own name, put it into your trust, negatively gear the property that's in your personal name for the tax benefit, and increase the profitability on the property in the trust to make sure that that trust no longer has that issue. Now, please tell me if I've explained that well or I've glossed over it.
No, you have explained that extremely well.
Great, because I practiced it like 4 times because I was like, this is where it gets confusing.
All right, fellow property investor. If you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.